students, during the previous session we discussed about calculation of interest on capital. In today's session we will be learning how to calculate interest on drawings in different situations. Let us look at the first situation, when fixed amount is withdrawn every month. So, in this case partners in a partnership firm will be withdrawing resources with a fixed amount every month, say rupees 1000 on every first day of each month, or middle of every month, or last day of every month, and so on. So, here interest will be calculated using an easiest method called average period method, which has formula like this: interest equals to total drawings into rate of interest into average period, I write AP, into 1 by 12. So, what is this average period? Let us take one example. Suppose partner A withdraws rupees 1000 each month on first day, that is first day of every month. Now, amount is fixed and time is fixed. So, in this case let us look at what is this average period. See, let us understand when will be the first drawings will take place. Since it is every month first day, suppose accounting period is like this 2015-16, starting from 1st April ending on 31st March 2016. First drawing will take place on 1st April 2015. Second drawing 1st May 2015, and so on. And the last drawing will be on 1st March 2016. Therefore, there will be total 12 drawings in that accounting period. Now, formula for average period is longest period plus shortest period divided by 2. So, what is this longest period? Longest period is the time period between the date of first withdrawal out of all those 12 withdrawals up to the last day of that accounting period. So, in this case last day of that accounting period is 31st March 2016. So, the longest period here is from date of first withdrawal, that is 1st April 2015, to the last day, that is 31st March 2016. So, that consists 12 months. Next, what is this shortest period? Shortest period is the time between the date of last withdrawal to the last day of that accounting period. Out of these 12 drawings, last withdrawal was on 1st March 2016. From that day to the last day of that accounting period is 1 month. So, shortest period is here 1 month. Now, average period equals to longest period plus shortest period divided by 2, that is 13 by 2. This is how we calculate the average period for the purpose of calculation of interest on drawings. Now let us consider that that partner has withdrawn 1000 every month on middle of each month. In the middle of each month means 15th of every month. And let us look at what is this average period in this case. So the first drawings, when would be the first drawings take place? 15th of every month, that means first drawing will take place on 15th April 2015, same accounting period 2015-16, and the second drawing will take place on 15 May 2015, and so on, and the last drawing will take place on 15th March 2016, and in total there will be 12 withdrawals. So what is average period? Now longest period plus shortest period divided by 2. Longest period, let us see. The first drawings was on 15th April. So longest period is from the date of first drawings to the last day of that accounting period. That means in April we have 15 days, and from May till March 31st we get 11 months. So there are 11.5 months. Coming to the shortest period, last drawing was on 15th March 2016, and accounting period ends on that month 31st. So there is 15 days, means 0.5 month. Now average period equals to longest period plus shortest period divided by 2, that is 12 by 2. So this is when every month in the middle of that month if drawings are made. Next, what if drawings are made on last day of each month or every month? So the first drawings will take place on 30th April 2015, second drawings 31st May 2015, and so on, and the last drawing would be on 31st March 2016. So average period, longest period plus shortest period divided by 2. So in this case longest period is from 30th April 2015 to 31st March 2016. So we have to count months from May. So May to next March there are 11 months, that is the longest period here. Coming to the shortest period, last drawings was on 31st March 2016, and accounting period ends on that day only, that is 31st March 2016. So shortest period consists 0 months. Therefore average period equals to 11, that is longest period plus shortest period divided by 2, we get average period as 11 by 2. So depending on the day on which withdrawal is made, this average period may change. So, considering that example, every month rupees 1000 was withdrawn. Maybe for example, rate of interest is 5% per annum. So, suppose it is first day of every month, then interest will be equal to total drawings. So, we have to calculate the total drawings now. Each month 1000 has been withdrawn. There are 12 months in that accounting period. So, total drawings will be equal to rupees 12,000, monthly 1000. So, total 12,000 into rate 5 by 100 into average period. So, when drawings is made on every first day, then we get average period as 13 by 2 into 1 by 12, and answer will be rupees 325. So, if drawings is made middle of every month, then interest on drawings will be total drawings, here also rupees 12,000, every month 1000, total months 12, so 12,000 into rate of interest 5 by 100. Now, average period will be 12 by 2 into 1 by 12, and amount will come to rupees, and amount will come to rupees 300. Suppose withdrawal is made at the last day of every month, then interest will be, now total drawings 12,000 into 5 by 100 into average period 11 by 2 into 1 by 12, and amount will come to rupees 275. So, this is the first situation where fixed amount will be drawn every month for a fixed period. So, next we will look at the second situation in which fixed amount will be withdrawn quarterly. So, how many quarters are there? In an accounting period, say 2015-16, there are 12 months and 4 quarters. So, Q1 first quarter, Q2 second quarter, Q3 third quarter, and Q4 fourth quarter. So, quarter 1 consists of 3 months, April, May and June. Q2 consists 3 months, July, August and September. Q3 consists October, November, December, and Q4 January, February and March. So, in an accounting period there are 4 quarters, Q1, Q2, Q3 and Q4. Now, the situation is quarterly a fixed amount is withdrawn. So, here we get 2 different dates, like one is on first day of every quarter, and second is last day of every quarter. Let us look at this situation. So, first day of every quarter. So, the first quarter here is April, and first day we have to take. So, the first drawings will take place on 1st April. In our case, it is 2015. Second drawing will take place during first day of second quarter, that is 1st July 2015. Third drawings will take place on first day of quarter 3, that is 1st October 2015, and last drawing will take place on first day of Q4, that is 1st January 2016. So, in an accounting period there are 4 quarters and there will be 4 withdrawals. Coming to the the other case, last day of every quarter. So, the first drawings will take place on last day of first quarter, that is June 30th, 2015. Second withdrawal will take place on last day of Q2, that is 30th September 2015. Third drawings will take place on last day of Q3, that is 31st March 31st December 2015, and the last drawing will take place on last day of Q4, that is 31st March 2016. Here also there will be 4 withdrawals. Let us look at average period now, because formula for calculating interest in this case is the same, that is interest on drawings is equal to total drawings into rate of interest into average period into 1/12. So, look at looking at average period here, longest period plus the shortest period divided by 2. So, under this case longest period will be from the date of first withdrawal to the last day of that accounting period, 31st March 2016. So, how many months are there? 12 months are there, April to next March. Longest period will be 12 months. So, what will be the shortest period? So, shortest period is from last day, last withdrawal to the last day of that accounting period, that is from 1st January 2016 to 31st March 2016. So, January, February, March, that consists 3 months. Therefore, average period equals to longest period plus the shortest period divided by 2, that is 15/2. Coming to the other case, when withdrawal is made on last day of every quarter, now the average period will be same formula, longest period plus the shortest period divided by 2. Longest period will consist of how many months? Look at the date of first withdrawal, that is 30th June 2015. So, from this date to the last day of that accounting period. So, count from July to the next March, you get 9 months, that is July, August, September, October, November, December, and January, February, March. And the shortest period will be, look at the last withdrawal on 31st March 2016, from that day to the accounting period last day, that is 31st March 2016, meaning same day. So, there is 0 month or 0 period, because both the dates are same. So, here average period will be longest period plus the shortest period divided by 2, that is 9/2. And using this average period, we can calculate interest on drawings. Let us look at this situation with an example. There are 2 partners, Ram and Shyam, who share profits and losses equally. Ram withdrew rupees 1000 per quarter regularly during the year 2015-16. So, Ram has withdrawn 1000 every quarter for I mean during that accounting period, that is 2015-16, rate of interest is given 5%. Calculate interest on drawings of RAM under average period method. So, there are two possibilities. RAM can withdraw all those drawings on first day of every quarter or last day of every quarter. So, suppose he has withdrawn on first day of every quarter, what will be the interest on drawings? So, the formula interest on drawings is equal to total drawings into rate into average period into 1/12. Every quarter he is going to withdraw rupees 1000. So, in that accounting period there are 4 quarters. So, total drawings will be 1000 into 4, that is 4000, multiplied by rate of interest, that is 5%, into average period. So, when withdrawal is made on first day of every quarter, we have already calculated the average period, which comes to 15/2 into this 1/12, and answer we get is rupees 1000, I mean rupees 125, not 1000, it is rupees 125. Suppose withdrawal is made on last day of every quarter, then interest will be the total drawings same rupees 4000, every quarter rupees 1000, into rate of interest 5/100 into average period. Now, average period is 2/9, 9/2 into 1/12, and amount comes to rupees 75. So, this is situation second or B, that is when fixed amount is withdrawn quarterly. So, after this we will look at the case 3 or situation 3, which is when varying amount or amounts are withdrawn at different intervals. So, how to calculate interest on drawings? Under situation A and situation B, we can easily follow that average period method, but we can't apply that average period method in this situation. To this situation, we have a different method, that is called product method. So, using product method, we can easily calculate interest on drawings when the drawings are made with varying amounts at different time intervals. Now, the formula here is interest on drawings equals to total product into rate into 1/12. So, here we get total product. So, what is this total product? Actually, we have to calculate total product using a formula, that is amount of withdrawal into period outstanding for that withdrawal. So, after calculating that, we have to add products to find out total products, and then we can apply this formula. Let us look at one example to understand this situation easily. So, there is a partner, his name is Govind. He withdrew rupees, different amounts of rupees at different time intervals. Details are given here. Accounting period is 2015-16. Partner's name is Govind. Rate of interest is also given, that is 6% per annum, and accounting period ends on March 31st, 2016. So, they have mentioned different amounts of drawings here. I will write that one. So, first drawing he made was 30th April 2015 and amount is rupees 6,000. Second drawing was on 30th June 2015 with an amount rupees 4,000. Drawings number 3 was on September 30th 2015 and amount was rupees 8,000. Fourth withdrawal was on 31st December 2015 with an amount 3,000. And the last withdrawal was on 31st January 2016, rupees 5,000. So, these are the withdrawals Govind made during that accounting period 2015-16. So, now we have to use product method. For that, we have to take two extra columns here. One column is for outstanding period in months and last column for product. So, what is this outstanding period? Outstanding period is from the date of withdrawal to the last day of that accounting period, which is 31st March 2016. So, here in the case of first withdrawal, date is 30th April 2015. From this date to last day of that accounting period consists 11 months. So, 11 is outstanding period. We have to multiply outstanding period to amount of withdrawal to find out the product. So, here 11 into 6,000 we get 66,000 as a product. Coming to the second withdrawal, date is 30th June 2015 and we have to calculate outstanding period. So, from July 1st till 31st March there are 9 months: July, August, September, October, November, December and January, February, March. 9 months are there. So, what is product? Outstanding period into amount of withdrawal. So, 9 multiplied by 4,000, answer we get 36,000. Next, third withdrawal was on September 30th. From that day to the last day of that accounting period, 31st March 2016, how many months are there? 6 months are there: October, November, December, January, February, March, and product will be equal to 6 into rupees 8,000, that is 48,000. Coming to withdrawal number 4, day is 31st December 2015, last day of that accounting period is 31st March 2016. So, there are 3 months and the product will be 9,000. Coming to the last withdrawal, which took place on 31st January 2016 and number of months outstanding is 2 months, February and March. So, total product here is 10,000. So, let us add all these products to find out total products. 66,000 plus 36,000 plus 48,000 plus 9,000 plus 10,000. The total we get is 1,69,000. So, coming to the formula, interest equals to total product into rate into 1 by 12. Total product 1,69,000 into rate of interest is given here 6 by 100, that is 6%, into 1 month of outstanding period, that is 1 by 12, and answer comes to 845 rupees. So, this is how product method is applied to find out interest on drawings easily when varying amounts are withdrawn at different intervals. And one more situation is there, that is fourth situation, when dates of withdrawal are not specified. So, under this situation, total drawings made by a partner will be given, but date or timing of such withdrawals will not be given. So, then how to calculate interest on capital in such a situation? There is a formula for that, which is like this: interest on drawings is equal to total drawings into rate into half of accounting period. In an accounting period, usually we take 12 months time. So, half of accounting period means 6 months, that is 6 by 12 we have to take. So, let us look at this situation with an example. So, suppose Govind had withdrawn rupees 26,000 evenly throughout the year 2015-16. Evenly throughout the year 2015-16 means dates are not given, but he has withdrawn on an evenly basis at a 6% per annum. Rate of interest is given, that is 6% per annum. So, what is interest on drawings here? We have to take total withdrawals. So, in this case it is directly given rupees 26,000 into rate is 6 by 100 into half of accounting period. So, this is year 2015-16 consisting 12 months. That means, we have to take half of that accounting period as 6 by 12, 6 months, and amount will come to rupees 780. So, when date is not given, we can calculate assuming that withdrawals will be made evenly throughout the year, and with using this formula we can calculate interest on drawings. So, that is all for today's session. We will continue remaining topics in next sessions.